All right, let me read this. A CPA firm is considering providing bookkeeping, tax compliance, and an audit to the same non-issuer client. Which combination preserves independence under the AICPA code if the firm also prepares routine journal entries? Management accepts responsibility for financial statements. CPA implements a safeguard and obtains a signed acknowledgement from management. CPA posts entries and prepares draft statements. Management reviews and approves. A. Permitted, because bookkeeping is always allowed if disclosed to those charged with governance. B. Permitted if the CPA does not assume management responsibilities and management oversees the services. C. Prohibited because any preparation of entries impairs independence for an audit. D. Prohibited because tax compliance and auditing are mutually exclusive services. Okay, now I'll walk you through this. Slow, precise, and fully aligned with the AICPA code for non-issuer audit clients. First, the AICPA code lets me perform non-attest services, like bookkeeping, drafting statements, and tax compliance, for a non-issuer and still stay independent, but only if I do not assume management responsibilities and the client's management takes the wheel. What does management takes the wheel mean in code speak? It means management designates a competent individual to oversee my work, accepts responsibility for the results, makes all decisions, and reviews and approves what I prepare. Also, I must establish and document the understanding in writing, objectives, services, my responsibilities versus management's responsibilities, and I should obtain management's acknowledgement that they accept those responsibilities. That's the independence safeguard package. Now, look at the facts they gave us in the STEM. Management accepts responsibility for the financial statements. Good, that's required. I implement a safeguard and obtain a signed acknowledgement from management. Good, written understanding and acknowledgement are required. I post routine entries and prepare draft financial statements, but management reviews. Good, I'm assisting, not deciding. That's exactly the fact pattern the AICPA code envisions for permitted non-attest services alongside an audit of a non-issuer. I'm allowed to prepare routine journal entries and draft financial statements as a non-attest service so long as management reviews, approves, and accepts responsibility. I cannot make the decisions or act as management. I can only assist. Now, the choices. Choice A says bookkeeping is always allowed if disclosed to those charged with governance. That word always is the exam trap. Disclosure alone isn't enough. I still must avoid management responsibilities, and the client must oversee and accept responsibility with a documented understanding. So A is too absolute and incorrect. Choice B says it's permitted if I do not assume management responsibilities and management oversees the services. That is precisely what the code requires for non-attest services with an audit of a non-issuer. This matches the written acknowledgement plus oversight, acceptance of responsibility, correct. Choice C says any preparation of entries impairs independence. That's not the AICPA rule for non-issuers. Preparing entries can be okay if management oversees and accepts responsibility and I'm not making management decisions. So C is incorrect. Choice D says tax compliance and auditing are mutually exclusive. That's just wrong under the AICPA code for non-issuers. Tax compliance services can be performed for an audit client as long as the non-attest service safeguards and oversight conditions are met.
So D is incorrect. So the right answer is B. Quick exam strategy I want you to keep. When you see non-attest services plus audit in a non-issuer context, immediately check these 4 boxes in your head. No management responsibilities for me. I don't decide, I advise. Competent management designated to oversee. Written understanding of the services and responsibilities. Management acknowledgement that they accept responsibility and approve the results. If all 4 are present, independence is preserved under the AICPA code for non-issuers, even if I draft statements and post routine entries. And here's the punchline to stick it. I'm the GPS, not the driver. I can map the route, suggest turns, and even print the directions, draft the statements, but management has to steer, hit the brakes, and sign the rental agreement. If I grab the wheel, independence crashes. Final answer, B. Permitted if the CPA does not assume management responsibilities and management oversees the services. Moving on to the next question. Which of the following procedures would an auditor most likely perform in planning a financial statement audit? 1. Make inquiries of the client's lawyer about pending litigation. 2. Perform cutoff tests of sales and purchases. I'm going with D, neither 1 nor 2. Now, let me show you exactly why, standard by standard. Why no 1 lawyer inquiry is not planning. When I'm planning, I'm focused on strategy and risk assessment, not on obtaining attorney letters. Under AUC 300, Planning and Audit, planning is about establishing the overall audit strategy and developing the audit plan. Under AUC 315, I obtain an understanding of the entity and its environment, including legal, regulatory framework, and identify risks. I can ask management about litigation at this stage and read BOD minutes, but I don't go to outside legal counsel yet. Direct communication with external legal counsel is governed by AUC 501, Audit Evidence Specific Considerations for Selected Items. The attorney letter is a substantive evidence procedure typically performed during field work and closer to report date, after I've identified contingencies and after management has prepared their list of pending matters. In short, planning equals understand risk, attorney letter equals obtain evidence later. Translation: in planning, I may flag legal exposure, but I don't lawyer up with an attorney letter until I'm gathering evidence. Why number 2, cutoff tests, is not planning? Cutoff testing is a substantive test of details. I'm verifying that transactions near period end are recorded in the correct period. Existence, completeness, that's squarely in AUC 330, responses to assessed risks. Performing further audit procedures to obtain sufficient appropriate evidence. Planning activities don't include testing transactions. Planning is where I decide what to test, how much, when, and with what approach, not to actually do the cutoff tests. In planning, I decide which doors to knock on. In fieldwork, I actually knock on them. Cutoff tests, confirmations, vouch trace, etc. What planning does include, so you can spot the right verbs on the exam, you may do preliminary inquiries of management about litigation and read minutes during planning, AUC 315, but formal attorney letters, AUC 501, are evidence procedures, not planning. Cutoff belongs with other substantive work, AUC 330. If an option says perform cutoff tests and planning, that's a category error. Exam strategy, baked right into how you answer. When the STEM says planning, run a 2-step filter. Is this about deciding and understanding? Yes, planning. Or is this about obtaining evidence on assertions? Yes, fieldwork, substantive, not planning. Keywords that almost always mean not planning: confirmations, cutoff tests, inventory test counts, unless it's just scheduling, attorney letters, reperformance of controls, vouch trace samples. Those are evidence-gathering steps.
All right, let's read this one carefully. The question says, under the AICPA code, which situation most likely creates an independence impairment for an employee benefit plan, EBP audit under DOL rules? Now, let's unpack each one. Option A. The firm's HR director is just a participant in the plan, contributing like every other employee. That's totally fine. The Department of Labor allows normal employee participation in benefit plans. That doesn't impair independence. Option B. A partner sitting on the client's investment committee, even if they claim they don't vote. This one is tricky. The moment a partner sits on a governance body like an investment committee, independence is impaired. The DOL doesn't buy the no voting rights excuse. Just being in that role is participating in management.
This one looks bad. Option C. The firm did the plan's monthly record keeping last year and still hosts the live general ledger. That's a direct management function. If you're running the books, you're not independent. This is one of the clearest ways to blow independence under both the AICPA code and DOL rules. Option D. An IT specialist just shows up at a meeting to explain SOC 1 results. That's just informational, not management participation. No independence problem there. So between B and C, both are ugly. But the question asks, most likely creates an independence impairment. Hosting the live general ledger is flat out performing management's role. That's the textbook definition of an impairment. So the best answer is C, the audit firm performing the plan's record keeping and hosting the live general ledger. Here's the memory hook. Independence is like a fence around the auditor. It's fine to be inside the plan as a participant, and it's fine to explain information. But the second you're running the books, you've climbed over the fence and are managing the plan yourself. Final answer, C. Here's the question. A CPA discovers a longtime tax client now wants an attestation examination over its ESG metrics. Which combination of statements is correct about the practitioner's responsibilities before acceptance? Evaluate independence under the AICPA code and applicable attestation standards. Determine whether suitable available criteria exist for measurement. Now, let's walk through this. First, I remind myself what's happening here. I'm moving from a tax relationship into an attestation engagement, which is a different ballgame. Tax work is about preparing and advising, but attestation, like an examination or review, is about giving assurance to outsiders. That means independence requirements immediately come into play. So let's look at Statement 1. It says I need to evaluate independence. That's absolutely correct. And when I say independence, I don't just mean I feel unbiased. Independence has two sides. Independence in fact and independence in appearance. Independence in fact means deep down I truly am objective. No conflicts, no ties, no decision-making for management. Independence in appearance means that outsiders looking at me and my firm would also believe I'm objective. Even if I think I'm neutral, if the public sees a relationship that looks like I'm too cozy with the client, independence is impaired. For an attestation, I have to pass both tests. Now, Statement 2. It says, determine whether suitable, available criteria exist for measurement. This is also essential. I can't provide assurance over something vague. ESG, which stands for Environmental, Social, and Governance, covers things like carbon emissions, diversity metrics, employee safety, and governance structures. But I can't audit ESG in the abstract. I need clear criteria, such as GRI standards, SASB standards, or another accepted framework that makes the ESG numbers measurable and comparable. Without criteria, there's no way to form an opinion that has meaning. So when I put it together, both Statement 1 and Statement 2 are correct. That makes the right answer C, both 1 and 2. Whenever you see a question about whether you can take on an attestation engagement, your brain should go straight to two checkpoints. First, can I stay independent in both fact and appearance? Second, are there suitable criteria for measuring the subject matter? If either one is missing, the engagement is a no-go. Think of myself as a referee stepping into a new match. Independence is making sure I'm not only neutral, but also not seen chatting with the team captain before the game. ESG is the scoreboard for how green, fair, and well-governed the company is. But without a rule book, the suitable criteria, I can't call the game. Final answer, C, both 1 and 2. All right, here's the question. You are auditing a non-issuer and plan to rely on an outside valuation specialist engaged by management. Which action best aligns with professional responsibilities? A. Accept management specialists' work at face value if they are credentialed. B. Assess the specialist's competence, capabilities, and objectivity, evaluate the relevance and reasonableness of their work. C. Engage your own specialist only if materiality is high, otherwise rely on management. D. Request the specialist to sign the engagement letter as a responsible party. Let's break this down. The first option says accept the work at face value if the specialist is credentialed. That's way too trusting. Just because someone has letters after their name doesn't mean I can blindly rely on them. I still have to evaluate their work. Otherwise, it's like assuming every chef with a hat automatically makes a good steak. Sometimes you still end up chewing rubber. The second option says assess the specialist's competence, capabilities, and objectivity, and evaluate the relevance and reasonableness of their work. That is exactly what I'm supposed to do. I don't redo the entire valuation myself, but I do kick the tires to make sure it makes sense. This is the professional, responsible approach. The third option says engage my own specialist only if materiality is high. Materiality affects how much I test, sure, but it doesn't excuse me from my responsibility to evaluate management specialist. I can't just shrug and say, well, it's a small number, so I'll trust it. That's not how audit responsibility works. The fourth option says request the specialist to sign the engagement letter as a responsible party. Nope, management is responsible for the financial statements, not the specialist. The engagement letter is between me and management, period. Asking the specialist to sign it would be like inviting the plumber to co-sign your mortgage. Doesn't make sense. So the only choice that lines up with professional responsibility is number 2. Assess the specialist's competence, capabilities, objectivity, and evaluate the relevance and reasonableness of their work. Think of using a management specialist like borrowing your friend's car. You don't rebuild the engine yourself, but you do check that the tires aren't flat, the brakes actually work, and the gas gauge isn't lying. You don't just jump in because your friend says, "Trust me, it's fine." Final answer, B. Assess competence, capabilities, objectivity, and the reasonableness of their work. All right, here's the next question. Which statement is true about confidentiality under the AICPA code? 1. A CPA may disclose client information to comply with a valid subpoena. 2. A CPA may disclose information during a peer review without client consent. 3. A CPA may disclose information to defend themselves in a professional liability lawsuit. 4. A CPA may sell client lists with full working papers without consent if the purchasing firm is also a CPA firm. First, the baseline rule. Under the AICPA code, client information is confidential and cannot be disclosed without the client's consent. That's the default. The code then lists very limited exceptions where disclosure is permitted or required. The exam is checking whether you can spot those exceptions and separate them from the no-nos. Now let's look at each statement. Statement 1 says a CPA may disclose client information to comply with a valid subpoena. That's correct. If a court issues a lawful subpoena, I have no choice but to provide the information. The code makes clear that compliance with laws and regulations is an allowed exception. Refusing would put me in contempt of court. Statement 2 says a CPA may disclose information during a peer review without client consent. This is also correct. Peer reviews are a built-in part of the profession's quality control system, and the AICPA specifically carves out an exception for this. The idea is that the integrity of the profession depends on independent reviewers being able to look at engagement files without every client having to sign off. Statement 3 says a CPA may disclose information to defend themselves in a professional liability lawsuit. That's also correct. If a client sues me or files a complaint, I can use their information in my defense. Otherwise, I'd be stuck trying to protect myself with one hand tied behind my back. The code recognizes this as a valid and necessary exception. Statement 4 says a CPA may sell client lists with full working papers without consent if the purchasing firm is also a CPA firm. This one is false. Client lists alone, just names and contact information, may be sold or transferred as part of a practice sale, but working papers are different. They contain confidential details and are the property of the CPA firm. To transfer or share those, client consent is required. The fact that the buyer is also a CPA firm doesn't waive that requirement. So the correct group is statements 1, 2, and 3. That makes choice A the right answer. Exam strategy here: the test writers love to give you 1 or 2 obvious yes items, then sneak in a tempting extra that goes too far. The phrase "sell client lists with working papers" is the trap here. The sale of a client list is allowed, but the working papers part ruins it. Always read the full wording, because one extra phrase can flip a statement from true to false. And to keep it sticky, I can disclose if the court makes me, the profession reviews me, or I need to defend me. But I can't just dump the client's files in a moving box and sell them off with the furniture. Final answer: A, 1, 2, and 3 only.